A freelance designer received a 1099-K from Stripe showing $87,000 in payments. She filed a Schedule C reporting $61,000 in income. The IRS computer matched those two numbers automatically. Within 8 months, she received a CP2000 notice, a proposed assessment of $6,200 in additional tax, plus $1,240 in accuracy-related penalties. The $26,000 difference was real expenses. She had simply not kept the records to prove it. This is not an unusual story. It is increasingly common. The IRS estimates the annual tax gap, the difference between taxes legally owed and taxes actually paid, at approximately $600 billion. Self-employed individuals and small businesses account for the largest share of that gap, largely because there is no employer withholding. When you have a W-2 job, your employer withholds taxes on your behalf. When you are self-employed, that mechanism does not exist, and compliance depends entirely on voluntary reporting. The IRS has known for decades that underreporting is concentrated in this segment. The American Rescue Plan of 2021 lowered the 199K reporting threshold for payment processors from 20,200 transactions to 600. The IRS delayed implementation multiple times. The current phase-in is $5,000 for the 2024 tax year, $2,500 and $600 from 2026 onward. The effect is that Stripe, PayPal, Venmo for Business, Cash App, Etsy, eBay, Airbnb, Uber, Lyft, and similar platforms now issue 1099-K forms to millions of sellers and service providers who never received one before. The IRS matching process is automated. When you file a tax return, the IRS computer compares the income you reported against every information return filed under your Social Security number, or EIN, including 1099, K, 1099, NEC, 1099, MEC, and W-2 forms. If the numbers do not reconcile, the system generates a discrepancy flag. This is not a human decision, it is a database query. The CP2000 notice that results is the IRS proposing to adjust your return based on the information it already has. The audit rate for self-employed individuals with Schedule C income above $100,000 is approximately 1.6%. Roughly 4 times the rate for W-2 employees in the same income range. For sole proprietors earning between $25,000 and $100,000, the rate is about 0.9%. These rates have declined significantly over the past decade due to IRS budget cuts. But the Inflation Reduction Act of 2022 allocated $80 billion in new IRS funding specifically for enforcement, a significant portion of which is directed at high-income and self-employed filers. The deductions most commonly scrutinized on a Schedule C audit are meals and entertainment, home office, vehicle expenses, and travel. The IRS looks at 2 things: whether the expense was ordinary and necessary for the business, and whether you can document it. Documentation means receipts, bank statements, mileage logs, and a contemporaneous record of the business purpose. I had lunch with a client is not documentation. Lunch with Sarah Chen, Acme Corp. Discussed Q4 contract renewal, 9427. Receipt retained is documentation. There are 4 specific deduction categories that consistently trigger IRS scrutiny on Schedule C returns. The first is meals at exactly 50% of income. The IRS is aware that some preparers apply the meals deduction as a percentage rather than based on actual receipts. The second is vehicle expenses that appear implausibly high relative to the nature of the business. The third is home office deductions claimed on a return that also shows a loss. The home office deduction cannot create or increase a net loss. The fourth is travel to locations that are also personal destinations. The distinction between a legitimate business expense and a personal expense disguised as a business expense is documented business purpose. The IRS does not object to a business owner having lunch, owning a vehicle, or traveling. It objects to calling personal expenditure a business deduction. A meal is deductible if it is directly related to active business conduct, includes a business associate, and has a documented business purpose. A vacation to Miami is not a deductible business trip because you attended a single industry event on one of 5 days. If you receive a 1099-K and the amount on the form includes non-taxable amounts, personal reimbursements sent through Venmo, for example, you are entitled to adjust. Report the full SOS 99K amount as income. Then deduct the non-taxable portion with a clear description on Schedule C. The IRS wants to see the 199K total appear somewhere on your return. What it does not want is for a 1099-K showing $47,000 to simply not appear anywhere on your filing. That is what generates the automated notice. Reconcile every 199-K you receive against your actual income. If you accepted payments through multiple platforms, add them up and make sure every dollar appears on your return. Keep receipts for every deduction you claim. Use accounting software, QuickBooks, Wave, or similar, to categorize expenses throughout the year rather than reconstructing them in April. If your deductions are legitimate, document them as though you expect to explain each one to an auditor, because at some point you might.